Thanks very much, and thanks Ed and Jacob. I have to say, after the two of you, I'm not sure how well I will speak on this topic of ESG, and regulation wouldn't be my strong point necessarily, even though I work in this area. I'm much more of a technologist. I would say, what I'm going to speak about today is just some of the areas where we see technology, and we're talking about RegTech and SupTech, where that can promote sustainability and assist in furthering ESG goals. And if we move on to the first slide, I guess one of the challenges that we see is, what does good look like? What does ESG mean? We're talking about data, and we talk about, the importance of ESG, but having gone through this recently in trying to incorporate ESG into part of our business strategy, there is no single definition of what that is. So there are lots and lots of different topics that come under environmental, for example. And if we look at CO2 emissions and the net zero goal, yes, there are technologies that can help. So we see that, for example, some of the cloud providers have very ambitious net zero targets. Google is carbon neutral today, but they hope to run on carbon-free energy by 2030. AWS, similar, they're looking at 2040, and Vizor, similar. So we have technology, I think, providers today who are saying that they can help firms in maybe achieving or towards achieving something like net zero or reducing their CO2 emissions. So removing some of that maybe on-premise systems that they have, using cloud providers as an example. But I think, as I mentioned, in environmental, there's lots of other areas where technology and digitalization plays a part. Probably a little bit late to be talking paper-based processes, but I think COVID has probably eliminated a lot of those in one fell swoop. So we would have seen, as recently as a few years ago, still lots of paper-based processes in place in regulators and also in financial services companies, and obviously digitalization and using workflow processes that are automated. You see things like DocuSign, for example, has revolutionized probably a lot of the legal sector and approvals that happen. And I think that's another area where technology can help firms to demonstrate an improvement in terms of their waste management, energy efficiency, etc. On the social side, I think probably the impact of RegTech and SupTech is probably relatively nascent. That there's obviously market conduct regulators are taking an increased interest in promoting diversity and inclusion. They continue to focus on product responsibility. We do see, for example, one of the FCA's ESG priorities is to enhance the transparency of listed companies and regulated firms' diversity and inclusion performance. So I see that there will be an increased focus from regulators on how firms are going to demonstrate that they are achieving their ESG goals. But I do see a problem there in the fact that it's still very subjective. There isn't really a standard way of talking about or demonstrating maybe your improvement in performance against ESG goals. So we're still very much at the I would say discussion phase in a lot of these areas. There's discussion papers that I mentioned that the FCA and Bank of England have published about how can they increase the pace of change on diversity and inclusion in boards in banks, etc. Probably the biggest area where RegTech and SupTech today plays a part is in governance. And some of the areas that Jacob referred to, we see new taxonomies and technology solutions emerging around SFDR, alongside existing solutions which are focusing on how they incorporate ESG risks more heavily into their risk management frameworks. I still see, having looked a little bit at SFDR, and again, I'm not an expert in this, but I still see a bit of an issue in how data is being asked for, and maybe the plans for how firms are going to be asked for this data, because it's still very template based. It still seems very subjective, and that makes it difficult, I think, both for firms to interpret what they need to supply, and also, to be able to compare apples with apples. So when you're looking at how a firm is responding to a bank, for example, how they're responding to their sustainability goals or how they've incorporated ESG, it still seems like it's going to be quite difficult at the moment without a very clear data model, for example. That's I think Jacob made a good point. You don't want to put in something that is very rigid, but at the same time, leaving it too open, it probably doesn't give firms enough guidance on what they need to supply. I think also another important area that Ed mentioned is AML and that area. And I think that's an area that probably my view is that we're kind of failing on it. I don't think the amount of with the amount of money that's been spent in this area, I still feel that in Europe and in other jurisdictions, we work in about 25, 30 countries around the world. And while there has been a lot of focus on client onboarding and things like that, when it comes to a macro view of AML at a jurisdictional level or even a more broader global level, it isn't possible at the moment really to have a big impact on catching fraud at source, because typically there isn't a way, and some of that's down to data privacy and GDPR and things like that, but typically today there isn't really a very easy way for data from across multiple banks or even across multiple jurisdictions to be compared and contrasted so that you can have a real impact on this area. So I'm going to focus a little bit more probably on an area that I'm most familiar with, given that that's the area we work in, which is kind of regulatory reporting, and where I see maybe that we can have or we need a little bit of a change going forward. So if you just move on to the next slide. If we look at how regulatory reporting works today, we see a lot of duplication and inefficiency, which is kind of contrary to the goals of a sustainable financial system. So, typically regulatory data models, etc., they're defined by the maybe EU, and national competent authorities will have their own, depending on whether it's a directive or legislative requirements, they may have their own version of that. And those data models are published in a human readable format, sometimes as templates, maybe a machine readable format as well. And the financial institution is then pretty fully responsible for interpreting and transforming data from their various source systems into these multiple aggregated templates. And then they push that data to the regulator in XBRL or XL or XML, whatever the format may be. And some of the problems we see with this model, and this isn't, this could be prudential data, statistical data, ESG risk-related data in future, and any type of data. The interpretation is probably, one of the key challenges. Every financial institution is trying to interpret what they're being asked for. And while there are taxonomies, I still feel when we're doing taxonomies at a more aggregated level of data, there's still quite a large interpretation challenge for firms. We spoke about, there's a little bit of a mention of Basel III there. The time that it takes, regulatory change can take years to implement. Months, I don't think it takes months in anywhere I've seen, but years typically to implement. And the implementation cost then is very high. So the regulator is paying for something. They're paying to implement new data models and rules. And the financial institution is also paying because they're doing that interpretation. They're hiring solution providers to help them source, transform, and implement those data. And typically then, the quality is still poor. So even after all of this money that's been spent, data quality still tends to be quite poor, I think, even with validation put in place. So if we look at maybe, potential for how things might work in future, and this is, if we move on to the next slide, just our view of maybe how we should be thinking about data. And I think it's really a mind shift, like a change in mindset. So rather than thinking about, once-off data requirements or templates that we need for a particular moment in time, taking that catchphrase, reduce, reuse, and recycle, which is something that we all know when we're thinking about recycling waste, for example. We know that the data volumes are actually getting bigger, so it's not necessarily about reducing the volume of data or the variety of data that's required, but can we look at reducing the amount of times that we need to go back and forth between the regulator and the firms looking for data and asking for particular data. So we do see, with the introduction of more granular input data models, and again, whether that's related to loans and deposits and transactions, or whether it's related to looking at collecting more granular data about ESG risks and so on. I think moving towards a more granular input data model that's closer to industry standards, that's closer to the standards that banks are operating at, will have the effect of reducing the amount of effort that goes in and the amount of times that the regulator needs to go back looking for data. Reusing, so again, we've seen this, we work with about 25 regulators, and we always see new regulatory requirements coming. We rarely see old ones being sunsetted, if you like. So, we have seen systems where, there's a regulatory requirement or regulatory template that may have been thought up, maybe not 20 years, but 10, 15 years ago, and it's still being asked for. And new ones are added. So we're asking for more and more data, but we're not actually looking at, can we reuse data that we have, or can we just scrap that old template that was looking at aggregate data and replace with a more granular data model. And I think, we're looking at a possible future where, ideally, where you have regulatory systems achieving more continuous improvement. So if you think of how Tesla pushes out automatic updates to its cars, if the regulator takes more, I would say, responsibility for the transformation of the data, for asking it the right questions. When you want to do stress testing, you're not necessarily having to go back to the banks and ask for new data, because you've got granular data that you can ask questions of in the way that you want. In terms of how this is implemented, there's lots of possible solutions. It could be more like a joint utility solution, co-funded or co-owned by regulators and FIs. Maybe each financial institution still takes responsibility for hosting all of the granular data, because again, there's massive data volumes here. You don't want the regulator to take on the job of the terabytes of data that every bank has. But making that data more accessible, maybe via API or other technologies that are out there today. And I think, that's probably where we see it going. I think where the technology is there today to do a lot of this. And I think what it needs probably is, it needs probably a broader change in mindset for how we think about getting data and how we think about exchanging data between financial institutions and the regulator, and moving from this kind of siloed view of data and systems into something that's a little bit more integrated. So they're just my thoughts, and I'd be happy to have any questions from Gerald or Ed or Jacob.